I think the biggest misconception is people think that their CPA is actively trying to reduce their taxes. And 90% of the times, the CPAs aren't charged with doing that. They're just simply reporting your information on the proper boxes, on the proper tax form, and then telling you what the result is. If you think about it, as a business owner, every dollar you get in, there's going to be a certain percentage that goes to what's called cost of goods sold. That's the money you have to spend to make money. It's literally a tripling of your net worth over 3 generations. If you look at 2 columns, and the first column is $10 million, and it gets taxed when dad dies and when the kids die, when the grandkids die. Over 3 generations, 10 million still turns into about 38 million. Not too bad. But within a dynasty trust, that same 10 million will turn into 128 million. It's literally more than 3 times as much because we're not getting hit with that 40% tax at each generation.
There's a difference between a dream chaser and a dream catcher.
Hey, everybody, and welcome to the Dream Catchers podcast. Now, we just skipped over to NOLA down in the bottom and found us a guy who knows a little bit about taxes. Now, we're not talking about a CPA, although he might have that credential too. But there are folks who actually practice tax law. And there are some people who have a desire to help people not pay Uncle Sam more than they absolutely have to. And that's where my friend Todd comes in. Todd works with Wealth Planning Law Group, and they help people who have exits do it in a tax efficient way. Now, a lot of people try to save cents in order, and they skip out on dollars because they try not to get people involved until absolutely the last minute. And what I've learned on this journey of people exiting and through the exits that I've been through is the more people you can get eyes on the thing that you're doing, who know what they're doing, the better off you are. So Todd, thank you so much for joining me on the Dreamcatchers podcast today on what I know is going to be an enlightening episode.
Thank you so much, Jerome. I really appreciate you having me on today.
Man, so I don't think many kids aspire to be a tax attorney. How did you even know that this was possible? Like, how do you get into something like this?
Well, it's kind of funny. I was always kind of conservative, and even though I didn't have any money growing up, I just kind of believe that people should work hard and limited government and stuff like that. And when I went to law school, I either wanted to be a defense attorney to try to fight the personal injury attorneys, or I wanted to be a labor lawyer to fight the unions, or I wanted to fight the IRS. And thank God for Professor Susan Kalenka. She was my tax professor at LSU. Quite frankly, I wasn't doing real well in law school and was very kind of disillusioned. And boy, I took that first tax class, and I just took to it. I was always real good in math, and it's highly complex. It's the most complex area of the law. People don't realize, you see all these personal injury attorneys all over the place. In Louisiana, the personal injury statute is literally based on one sentence, whereas the Internal Revenue Code has 82,000 pages of text, plus you have regulations, plus you have case law, plus you have IRS pronouncements and rulings. So, yes, you're right. There's a big difference even between a CPA and a tax attorney because, the CPAs, they go to undergraduate and they take some accounting courses, but they're learning a lot about different types of things like debits and credits and, how to do a balance sheet and profit and loss statements. And they're not really studying tax law like we do. After law school, I went for an extra year to get my master's in tax law. So there's not that many of us. I think in the state of Louisiana, we might have 20, 30, masters in tax law attorneys. And then a lot of them go into, Wall Street and finance. So to find a good tax attorney that can help you as a business owner With estate taxes and with income taxes, it's pretty rare. I think it's frankly a supply and demand issue. Why 88% of the people that have a formal meeting with me hire me. So we have a real high success rate, and I think it's because selling what we sell, which is legal protections for your assets, so that oftentimes we pay for ourselves, where we're telling our clients that if we're not getting you a 10-to-1 ROI, we haven't done our job.
10-to-1 ROI. So for every dollar I pay you, you're gonna save me 10 in taxes.
Yes, sir.
I don't know where you get better odds than that, man. That's all right.
We literally
So
have an entire income tax planning program called Roadmap to Zero Taxes that we don't charge hourly. We don't charge you, it's a percentage of the savings. It's literally 10% of whatever we save you. So it's a 10-to-1 ROI. And on the estate tax side, it's going to be closer to 20 or 25-to-1 ROI on it.
wow, you say that with such certainty. So one of the other interesting stats that you share with me is you've never had something that you did overturned. And that's
Yeah.
kind of a big deal.
Yeah, that's pretty cool. In 30 years, I've done thousands of transactions, and not one of mine's been overturned by the IRS or a divorcing spouse or a disinherited child or a former partner. So, yeah, I'm really proud of the work that we do, and frankly, that's what it's all about. I mean, we're not the cheapest law firm out there, and people, sometimes they're penny wise and pound foolish. They're when you hire us, I think one of the huge benefits is not only our expertise and experience and dealing with all kinds of different clients and assets, and everything's custom made for each one of our clients. It's a custom design. But to know that you have the peace of mind after you're finished paying us, to know that everything that we've talked about is going to in fact come true. There's no guessing about it. You can rest easy knowing that what we've planned is going to actually happen should you get disabled or die.
Now, Todd, I imagine that some people go talk to their neighbor their friend at the country club, their neighbor across the fence, and they get some great tax advice, or at least they think it is great. Um,
Yeah.
what are some common things that you have people come into your office with that they believe to be true, but just isn't so? Because I know the tax code changes, you know?
I think the biggest misconception is people think that their CPA is actively trying to reduce their taxes. And 90% of the times, the CPAs aren't charged with doing that. They're just simply reporting your information on the proper boxes, on the proper tax form, and then telling you what the result is. But they're not, how many CPAs are really out there every quarter saying, okay, let's look at this new retirement planning opportunity. Let's look at cost segregation. Let's look at, other things that we can do to help, secure your financials. And, people don't realize, if you think about it as a business owner, every dollar you get in, there's going to be a certain percentage that goes to what's called cost of goods sold. That's the money you have to spend to make money. So like your sales force, for example, and that might be 35-40%. And then you've got general and administrative, and that's going to be another 30 to 40%. So you're usually left with about 20%, and then the IRS is going to come in and take half of that. So if we can reduce your taxes, we in effect are doubling the amount of money that you're putting into your pocket, right?
Whoa.
Right?
Double?
Well, yeah, because you're paying half of it to the IRS. You got a 37% federal tax, state taxes in Louisiana, 6%. You have match tax on top of that for self-employment. So you add all that up and it's over 50%. So if we can knock that down, And there are things you can do. You know, we have two clients right now that have commercial real estate that we're doing something called a cost segregation analysis. The first one that we did, it's on $1 million building. The guy's going to get a $150,000 deduction. So we're putting another $65,000 into his pocket, and we can do it for last year. So we're going to go back and have his CPA amend his tax return and get him a nice, $55,000, $65,000 check that he can now go use to go hire somebody to grow his business, right?
That's a huge deal. I mean,
Yeah.
and it's wasted money, right? I
Right.
mean,
Exactly. It's money that all cost segregation does is it just speeds up your deductions. But a dollar is worth more today than it is worth, usually on some of these buildings, you're depreciating that building over 37 years. So you're only getting maybe 3% a year. Well, this bumps it all up. And there's other great strategies out there. I can tell you, and all your listeners out there, that the single best retirement plan I have ever seen in my life, I literally only discovered about a year ago. And most people know about 401ks, and in a 401k you might be able to put away maybe 28,000. It's not bad, but if you're making hundreds of thousands of dollars, it's not a big help. Plus, most of the money winds up going to your employees. Well, on top of that, you can put a profit sharing plan, which will get you up to about 69,000, which isn't too bad. But on top of that, you can put either what's called a cash balance, or even better, what's called a 412E3 plan in. And I can tell you, I don't know how old you are, Jerome, but at 57, I can put in $500,000 a year for like 5 years on a tax deductible basis. And it's all asset protected within a qualified retirement account with guaranteed benefits when I retire. It's the best thing I've ever seen. All tax deductible.
Is it new legislation?
No, it's been around for a while. Some people know about these cash balance plans, which are defined benefit plans, but there's some problems with them. In particular, if the investment advisor either does too well or too poorly, the IRS will actually come in and tax you. If you perform too well, they're going to tax you on the excess. And if you perform too poorly, there is actually 100% underperformance penalty. Whereas with these 412E3 plans, it's all fully insured because it's all within either a whole life or a fixed annuity. So it's all guaranteed by the insurance carriers. So for every dollar you put in, we can tell you exactly how much you're going to get when you retire. Really cool concept.
You can tell them exactly. So it's almost like a pension.
It is. That's exactly what it is, actually. So a 401k is what's called a defined contribution plan because the law literally defines how much you can contribute. A 412E3 and cash balance plan, however, is a defined benefit. It doesn't define how much you can contribute. It says based on your age and income, in order to replace your income when you reach 65, you can put in X amount. And the older you are, the more you can put in. So for most of my clients that are in their 40 and above, you can put in hundreds of thousands of dollars into a qualified retirement account. We have until September 1st of this year to make a contribution for last year. So if you have listeners who paid more than $50,000 of taxes, especially if you have 15 or fewer employees, we can actually implement a plan before September of this year and get a big tax deduction of potentially over $100,000 or more for last year and get you a refund for last year's taxes.
That's wild, because I think most people just assume, because I've never heard a CPA talk about any of this stuff. So
right.
There's a difference between a tax strategist and a tax preparer. Should we go down that rabbit hole a little bit?
Yeah, I think so. It's a great distinction. I think there's very few of us that are proactive tax strategists. again, most CPAs are busy just filing returns. They don't have the time to do proactive planning. Most tax attorneys, frankly, are kind of bookish and they don't really know how to market and communicate real well. I think God gifted me with the leadership gene. I've been in leadership positions in pretty much every organization I've ever been in, and I've done a lot of public speaking. So you combine that with my ability to take these very complex ideas and break them down into simple, bite-sized chunks that a layperson can understand. And I think that's what's led to so much of our success, frankly.
Wow. Wow, wow, wow. So let's go here. We work with a lot of founders who exit their companies and they're trying to figure out their next. And one of the things that they're always worried about is taxes. It's like, well, if I sell my company, am I actually going to have a whole lot of money left? Uh, what do you find when somebody's thinking about exiting is kind of their thoughts around taxes? Because I find like a lot of entrepreneurs don't have a ton of cash flow a lot of the time, so they're not even really thinking about taxes in a big way. But when you have a liquidity event where you have 7, 8, or 9 figures, taxes are going to be your biggest expense.
Absolutely. So, we try to encourage our clients to meet with us early, and it starts with the choice of entity. So many people nowadays are doing business as an LLC, but there's certainly S corps and C corps out there, and I can tell you that it can make a huge difference. We had one of our clients who exited that was in a C corporation, and certain C corporations can actually exclude $10 million of gain from the sale of the stock. And we were actually able to get him 2 exemptions. So when he sold his share, like his 1/3 share was worth, I think 40 million, 35 million, we were able to shelter 20 million of it from capital gains taxes. Yeah, so we saved him a ton of money. And then there's other things that you can look at too. There's actually what's called deferred sales trust. And the idea is you get the bulk of your money up front and you don't have to pay the taxes for like 20 years. So it's a way to defer the taxes. You wind up paying about 8% up front. So it is, it is a little bit of a hit, but not as much as the tax bill. And then you get to defer it for that long. So that's pretty cool too. And then there's a big difference as to whether the buyer is buying assets from you or the stock from you. If they're buying assets.
Hey guys, as you might know, a very small percentage of the people who actually listen to this podcast are subscribers. So do us a favor, subscribe. In fact, we did some analytics and we found out that only 25% of the people who listen are subscribers. And our goal is to get that to about 75% over the next 3 months. So do us a favor, hit the subscribe button so you get notified when our new episodes. We plan to bring immense value to you guys going forward as we continue to improve the content that we create at Dreamcatcher. Your dreams should be real. Let's get back to the show.
That's good for the buyer because they get basis step up in those assets. It's bad for the seller because a lot of times you're going to be paying ordinary income tax on the sale of those assets, as opposed to as the seller, you want to sell your stock because when you sell stock, you get preferable capital gains tax treatment. So that's a whole nother thing that we advise clients on is on how to structure the sale so that we can maximize the taxes.
And so that's going to, when you talk about the preferable capital gains, I assume that's long-term versus short-term capital gain.
Correct. Yeah. If you've held it for more than a year, you get long-term capital gains tax. So you're only paying 20% instead of paying like 37%. So it's a big difference.
Wow.
That's why the wealthy mostly pay capital gains tax, instead of ordinary incomes. It's not from wages, it's from their portfolio.
And I mean, I guess if you're a high income earner, there's a big difference in
there is
the tax rate.
Yeah.
Okay, so I come in, I just sold my business, or I'm thinking about selling my business. I'm not going to sell my business before I come see you, Todd. I'm thinking about selling my business. I come in, what kind of stuff do I need to know, or what do I need to be ready to talk about in an initial conversation with you?
Well, we got to talk about a bunch of things. We have to talk about the structure of your business and whether it makes sense to maybe switch for tax purposes. We had one of our clients that just sold a cannabis dispensary and did really well with it. And he was a C Corp, but unfortunately hadn't been a C Corp long enough to qualify for that exemption. So we had to get real creative with that planning because that was an asset sale. And one of the benefits under current law, at least, is that if either my client, who's the husband, or the wife dies, we'll get stepped up basis in that C Corp stock and can liquidate it after one of them dies and pay no capital gains tax, as opposed to a capital gains tax of maybe 20% on, I think he's getting 35 million, you know. So that's a $7 million savings by just holding it. So, you should be thinking about that. You should be thinking about your spouse and making sure that they're protected. Always think about trust, because at some point we're going to be moving assets either while you're alive or after death. And when we do, we always want to use trust structures so that if your kids get divorced, or if they get into a lawsuit, or a personal injury lawsuit, and some personal injury attorney's chasing them, as long as we have those assets in a trust, that we can protect the family's assets for generations.
So some people say the trust don't actually provide protection. It's just giving you anonymity.
Oh no, it's both. In fact, there's even what they call domestic asset protection trusts, that you can put your assets into one of these trusts, and then typically you and your wife and your kids are beneficiaries. But if you ever get sued, or your kids ever get sued, they can't get to the trust, because the trustee has the right to distribute it to somebody other than the person who's getting sued. So there's some really cool trust protections out there that absolutely will work in pretty much any environment. The critical part is that you have to plan in advance. If you wait and somebody's already sued you, it's going to be too late to transfer assets to a trust at that point.
Whoa.
Yeah.
Most people don't know about trust. Is there a specific amount of wealth that you should have before you start thinking about something like this?
Like I said, I never had any money growing up. So for me, $100,000 is a lot of money. I think if you have much less than that, then a trust probably isn't worth it. But if you have a couple 100,000 or more, I think setting up a trust makes a lot of sense, because if your child, like I said, is distraught over your death and goes drinking and gets in a wreck and Morris Bart sues them, then we want to make sure that money's protected.
So this is really interesting, because I think people who accumulate wealth, I call them first generation wealth builders, they get leery about giving somebody else control of that wealth since they work so
Right.
hard to build it. But
So the
that's
beautiful part,
necessary.
no, that's a great point, because people are worried about losing control. And when you gift something to a trust, you can lose control over what you gifted. So part of the critical part of structuring this, I think, is how do we structure the gift? And the answer is that we usually will put whatever you want to gift, whether it's cash or real estate, into an LLC. And then we'll classify the ownership of that LLC into 1% Class A voting and 99% Class B non-voting. So when we gift the Class B non-voting to the trust, we're getting it off the client's balance sheet so that the client doesn't own it anymore, but they retain that 1% Class A voting. So that means that they can pay themselves a salary, they can do a loan to themselves, they can hire and fire, they can continue to run the company just like when they owned 100%. But now they own 100% of the Class A stock, which is only one share. The other 99 shares, no, they don't really control them anymore. They're in a trust, but you're controlling the entity that represents those shares. Does that make sense?
It does. And then ownership, and I always find trust fascinating. I think they're complicated, but fascinating. And then the trust has a beneficiary and a trustee, and
That's
like
correct.
those people can't be the same, and all of that, all of that rigmarole. But that those 99 shares, if we just assume there's 100 shares, they are in the trust, and then the trust decides who the beneficiary of those shares are, right?
Yeah, the client will design the trust so that they name their children typically are the beneficiaries, and then we can do it in certain states like Delaware. We can make a dynasty trust so that the kids live off the income, and when they die, there's no death taxes. When the grandkids come up, they live off the income. When they die, no death taxes. Same thing with the great grandkids, great grandkids. And Jerome, it's literally a tripling of your net worth over 3 generations. So if you look at 2 columns, and the first column is $10 million, and it gets taxed when dad dies and when the kids die, when the grandkids die, over 3 generations, 10 million still turns into about 38 million. Not too bad. But within a dynasty trust, that same 10 million will turn into 128 million. It's literally more than 3 times as much because we're not getting hit with that 40% tax at each generation. Very, very powerful.
Wait. You just said 10 million turns into 38 if you get taxed, but 10 million turns into 128 if you don't get taxed.
That's correct.
So this generational wealth thing that people run around talking about has some real nuance. It's not just about making a pile of money right now, but it's protecting it from Uncle Sam and all the other termites that kind of erode away that wealth, right?
Yeah, absolutely.
So, all right, I'm getting super curious here, because I just don't hear many people talking about this type of stuff, and or they say it's only for the folks who have 5, 10, $20 million, right? Getting into the ultra high net worth, not even net worth or high net worth, but like ultra high net worth. This is something that's reserved for those folks. And you said, no, if you got a couple hundred, if you got 100, you probably should be thinking about it. You got a couple hundred. And in in today's society, I don't think that's out of the question to have a couple $100,000 between your
Right.
life insurance, whatever your home costs, um, some
Tyrant plan.
vehicles,
Yeah.
401k. Like, I mean, I don't think it's hard to kind of cobble that together, but most people aren't having that conversation. Now, I know there's like some exemption, right, for
Yeah. At the
transfers.
estate tax level, that's great. It's currently 13.61 million per spouse.
Mhm.
So in order to pay the estate tax, you have to be more than 27 million under current law. However, that law is expiring at the end of next year, at the end of 2025, and it's going to get cut in half. So now the estate tax exemption is only going to be 5 million inflation adjusted. So there's a lot of people that like are between 10 and 20 million that today don't have a tax, but that will have a tax next January, if they don't do the planning that should be done.
Wow. And so, I mean, I know we're in election year and,
Yeah.
different things happen because the people who have different focuses, but it's my understanding that there's some tax cuts that was sunset at the end of this year. And I think this, what you just mentioned was one of them, but are there some other ones out there that are looming that
Yeah,
can impact people?
everything's going to change if they don't do something, because it's not just the estate tax exemptions going down, it's that the income tax rates are going up. the brackets are going down. The exemptions are going to, some of the exemptions are going to change. There are just a tremendous amount of changes that if this law expires. But we think what's going to happen is after this election in November, we're assuming the new president and the Congress will get together and hopefully pass some legislation to give us some clarity on that.
Now, I know you're not an economist, but it seems like we kind of need some of this stuff to go away so that we can deal with our deficit.
Yeah, I mean
What
that's the problem, is that how do we fix this deficit? And some people say, well, just tax the rich. Well, what people don't realize is that the top 10% of all Americans are income wise are paying 73% of all the taxes. The bottom 50% of Americans only pay 3% of the income tax bill. So it's already extremely weighted towards the people who make a lot of money paying not just the same amount, it's actually a graduated amount, right? They're paying a disproportionate share of the tax bill.
no? Well, I don't think people understand the weighted averages. And hey, I got a whole lot of money, even if I pay a smaller percentage than you, when you stick count it, I'm paying more than you in aggregate. But
Yeah.
they're like, oh well, but as a percentage of your income, it's a smaller amount. I I guess I could argue either way. My thing is like you offered that there's a pathway to zero income tax. You have a
Yep.
plan for that. And I'm sure people are like, what in the world is he talking about? How could I pay zero income tax? Um, I've only seen it done through real estate with cost seg and bonus depreciation and a bunch of other stuff that, if you got a tax
And
strategist, they'll talk to you about.
there's even solar credits out there where instead of paying $1 to the government, you pay $1 to the solar and you get a full write off in credit. And then you still make a little bit of money off the solar deal as the years go by. So you're picking up 15% or so and not paying the government any money and actually investing in something that a lot of people believe is worthwhile, solar energy.
So what other is it just like tax credits? Like how do we get to zero? Zero just sounds phenomenal.
It is. It depends on the individual client. But, in addition to some of the ones we've mentioned, the 412(b)(3), the cost segregation, you can employ your kids. People don't realize that. And depending upon how old they are, we can actually run them up and potentially save you tens of thousands of dollars doing that. There's the Augusta rule where you can actually rent out your home for up to 14 days, tax free. So there's a bunch of different things out there. It just really kind of depends on the client. Home office deductions work. I take that for my house.
You got to take advantage of all of the incentives that the
Yeah,
government gives you
that's right.
to reduce your tax bill. And it's really, I think, a super important distinction that there's a difference between a tax strategist and a tax preparer,
Yeah,
and knowing that the person that's preparing your taxes is just reporting what happened.
yeah. I say it's like they're looking in the rearview mirror instead of looking through the front windshield to see what's ahead. They're just looking behind. That's what most tax preparers do. Look behind you, where you've been. They're not looking ahead.
Now, you shared a little bit earlier, and it mesmerized me. So I was like, man, I don't know if I want to ask questions about that or not. He's like, man, I got this guy or gal 2 exemptions for $10 million
Yep.
on. So half of what they got in proceeds from their exit was sheltered. Is that
Yep.
right?
That's right.
Now,
1202.
is it just was that just luck? Like, I mean, it just kind of fell together.
No, we have. That's one of the benefits of working with me is that besides being a tax attorney and a board certified expert in estate planning, I'm also a fiduciary investment advisor representative that's affiliated with Wealth Solutions and Emeritus. And we have offices in 8 different states. Keith Gillis is our primary broker and certified financial planner. And I work with him on the financial planning side with our clients, in addition to the legal work we do. And one of the great things is that we have access to literally the best experts in any area of tax and law and accounting around the country. So we worked with a guy by the name of Bob Keebler, who's just got an outstanding reputation as a tax CPA. And he helped us structure the guy's affairs before the exit so that we could actually take advantage of 2 of the exemptions. We saved them another $3 million on that.
You saved them another
3 million, yeah.
I mean, this thing just keeps adding up. A lot of people they think that the only way to reduce the tax bill is to give your money to charity.
And there are charitable planning vehicles that are just beautiful, charitable remainder trusts and private foundations. But yeah, there's all sorts of ways to beat the government out of the money. It's just a matter of structuring your affairs properly.
So, is there kind of a hierarchy? Like, do you go to giving it to charity first, or should you be taking advantage of the incentives in the tax code?
Take advantage of the incentives first, and then you look at charity afterwards. And I hate to do this, Jerome, but I'm actually running out of battery here. I've only got 1% left. I can rejoin by my phone if that makes sense.
Todd, this has just been interesting is not a strong enough word. This has been exciting for me to hear because I think that paying more in taxes than you have to is a sin. I think there's so much good that can be done with the dollars in the hands of the people who created the dollars. And so I just want to thank you for helping people not pay more in taxes than they absolutely have to.
Well, thank you so much for having me on today, Jerome. I really appreciate the opportunity.
If they want to learn more about how to get that zero income tax plan, what do they do?
It's simple. You just call us 504 900 2763, or you can visit our website at www.lawealthplan.com. That's LAWEALTHPLAN.com. And you can set a complimentary 1-hour consultation with me and my staff, where we'll do a free consultation for you. At the end, we can quote you a fee to do the work that we do. And if you decide not to move forward, we just close the file and there's no obligation. If you like the 88% of the people we meet with that hire us, then you move forward. Then we just depends on the type of case. If it's a income tax planning case, we just do it on a 10% contingency fee. If it's an estate planning case, we'll ask for half up front and half when we sign. Pretty straightforward.
Man, y'all take the guesswork out of it so the person's not out there wondering what their
the whole
bill is
goal.
going to be. That's phenomenal. All right, y'all. Y'all need to take action. Go to the website, get that plan so you can stop paying too much in taxes.
And we can help people. We can help people all around the country too. So, and any state.
That part. Nationwide, baby. Get in with Todd. Till the next time, your dreams should be real. We'll catch you on the next episode.